Hello friends, welcome to this lecture. This is very first lecture in the series where I will cover full bank finance management. In this lecture, we will cover exchange rate topic. You can make notes along with this video and use these as summary notes, and after these notes you don't need to read any other book or any other material. So friends, before we start, do subscribe to this channel by hitting the red subscribe button below this video so that you don't miss the next lectures. Also, do comment how you like this lecture and by giving your feedback in the comment section, which will help in improving the next lectures. Also, do stay till last of this video where I will share some preparation tools to clear this exam easily and effectively. So let's start. Friends, first let me show you what I will cover in this lecture. We first understand what is foreign exchange. Then we will learn about Forex participants. Then we will see features of Forex market. After this we will learn about currency pairs. Then we will learn an important topic on the types of Forex transactions. After this we will learn direct or indirect quote. Then we will learn another important topic from which many questions are asked, that is bid and ask rate. Then we will learn important topic of cross currency rates. After this we will learn about discount and premiums. And at last we will solve many case studies and problems. Friends, these days pattern of CAIIB is shifting towards case studies. And in this lecture, I will solve some case studies so that you can master this topic. Friends, cross-border movement of commodities, services, manpower and capital is one of the biggest drivers of economic activity. This module of bank finance management focuses on understanding the role of banking in this particular area, which is also known as international banking. For an exporter of goods manufactured in India but exported to USA, if payment received is in US dollars, then the exporter needs to convert the US proceeds of the bill into Indian rupees. So friends, if this importer receives the proceed of US dollars, then these dollars are of no use to him until and unless he converts these dollars into rupees. Similarly, for import of capital goods from France to India, but billed in euro, then importer needs to pay the company in euro by first converting Indian rupees into euro. Thus, conversion of currencies from the currency of invoice to home currency of exporters will be generally required across all border trades. Friends, this is nothing but foreign exchange. For the Indian exporter or the importer, the US dollars or euro is foreign exchange, while for American, who was buyer of Indian goods, and the French, who was seller of capital goods, Indian rupee is a foreign exchange. Also note that foreign exchange and business of dealing in forex are two important aspects of international banking. So, what is foreign exchange? A foreign exchange transaction is primarily defined as the exchange of one currency from another currency by two parties at an agreed price. And the ratio at which the currencies are exchanged is called exchange rate. You just saw in previous example where the Indian exporter needs to convert the US dollar received into Indian rupees, and in second example where the importer needed to convert rupees into euros so that he can make the payment to French company. All this exchange of currency is nothing but foreign exchange, and the rate at which this exchange takes place is exchange rate. Let's understand in detail with the help of an example. If 1 US dollar can be exchanged for approximately 67 Indian national rupees, then the exchange rate is generally denoted as 1 US dollar equals to 67 INR. Similarly, if 1 euro equals 1.436 for US dollars, then this means that 1 euro can be exchanged for 1.436 for US dollars. Let's move ahead and now see various Forex participants. There are various participants that trade foreign currencies, and some of them are: the first one is exporting companies. They basically convert foreign revenues into domestic revenues. Then we have importing companies. They convert foreign cost into domestic costs. Then we have commercial banks. They help customers in need of Forex. Next is investment funds or banks. They transfer funds for investments in or out of foreign countries. Then we have central banks. They manage reserves and Forex rates. Then we have individuals. They make investments and participate in trade. Please note that FEMA, that is Foreign Exchange Management Act, is the primary act controlling the activities related to foreign exchange. And this is controlled by RBI. Friends, this is important one-liner question which is often asked in the paper. Let's now see features of Forex markets. Friends, these markets exist around the globe. The main feature of this market is that it is continuous, that is, opens 24 hours a day. The market opens from Monday through Friday, and Saturday and Sunday being closed days. In India, the interbank market opens at 9 a.m. and closes at 5 p.m. These markets in fact operate round the clock in one or the other part of the globe due to difference in time zones. These markets operate not at a particular place, but geographically the markets are extended from Tokyo and Sydney in the east to London and New York in the west. When European markets open, there is already lunchtime in Indian markets. When Indian markets close, the US markets are about to open. Just before close of US markets, the Tokyo or Singapore markets are about to open. This is how the markets are able to work 24 hours a day. Now let's focus our attention towards currency pairs. Friends, a foreign exchange deal is always done in currency pairs. Just recall the two examples we saw at the start. The Indian exporter who converted US dollars to Indian national rupees and importer who convert INR to euros. So you can see in foreign exchange, the exchange deal is always done in currency pairs. But first, I would like to show you some basic currency terminology if you are not familiar with currencies of the world. USD is short for US dollar and symbol used is this. Euro is short for European Union currency, euro, and symbol is this. JPY is short for Japanese yen and the symbol used is this. GBP is short form for British pound and the symbol is this. INR is your own currency, home currency, that is Indian rupee, and symbol is this. CHF is short for Swiss franc, which is currency of Switzerland. Friends, remembering these are enough for examination as questions rarely come outside these currencies. Now coming back to our topic of currency pairs, you can see the currency pairs like these: US dollars Indian national rupee, British pound INR, or Japanese yen US dollars, or US dollar Swiss franc. Like this, you can have any number of currency pairs, but in any currency pair, there will always be two currencies involved. So as we saw, in a currency pair, the first currency is referenced to as base currency and second currency is referenced to as the counter or terms or quote currency. The exchange rate tells the worth of the base currency in terms of the term currency. That is, for a buyer, how much the terms currency must be paid to obtain 1 unit of base currency. Let us see an example. A US dollar INR rate is rupees 67. Now this implies that rupees 67 must be paid to obtain 1 US dollar. Friends, in foreign exchange, prices are highly volatile and fluctuate on real-time basis. In foreign exchange contracts, the price fluctuation is expressed as appreciation or depreciation or strengthening or weakening of a currency relative to other. For example, a change of US dollar INR rate from 67 rupees to 67.50 rupees implies that US dollar has strengthened or appreciated and INR has weakened or depreciated, since a buyer of US dollar will now have to pay more rupees to buy 1 US dollar than before. Let us now see types of foreign exchange transactions. This is an important topic. Friends, as foreign exchange is generally conducted across different time zones, the settlement is an important factor in determining a contract. In a contract, the actual payment in rupees and receipt in foreign currency may take place on the same day, next day, 2 days later, or even a month later, or even more. So, various ways in which the delivery can be settled are: the first is ready or cash basis, the second is term basis, the third is spot basis, the fourth is forward basis. Let's see all these one by one. The first is ready or cash basis. When the payment in rupees and receipt in foreign currency takes place on the same day, it is called a cash transaction or value today. Next we have term rate, where the deal is settled on immediately succeeding working day. If the settlement day is holiday in any of the two countries, the settlement date will be next working day in the both countries. Next is spot basis. This is when the currencies are delivered on the second day following the day of deal or contract. The exchange rate used for this purpose is called spot exchange rate. Also note here that if the settlement day is holiday in any of the two countries, the settlement date will be next working day in both the countries. At last we have forward transaction. In a forward transaction, the settlement of deal takes place on some predetermined future day after next 2 days. A forward contract for delivery 2 months means the exchange of currencies shall be completed after 2 months from date of contract. If you are feeling confused with all these terms, then let's see a practical example, and this will make things more clear. In this example, you can see 3 columns. The first column has date of contract, that is the date on which the deal took place. Then in second column, we have date of delivery. This is date on which the deal is settled. And last we will see what rate will be used out of the 4 transactions we saw in the previous slide. So let's say a deal took place on 4th November 2018 and the settlement took place on the same day, that is 4th November 2018. Then as you can see, the deal is settled on same day, as this is a cash or ready transaction. Also the rate used will be cash or ready rate. The second deal happened on 4th November 2018 but settled on 5th November 2018. As you can see, the settlement took place on second day. Thus, this is the term transaction, hence the rate used will be term rate. The third deal happened on 4th November 2018 but settled on 6th November 2018. Thus, as you can see, the settlement took place on second day from the date of deal. Thus, this is a spot transaction and thus rate used will be spot rate. This is also called TT rate. Fourth, we have deal took place on 4th November 2018 but the settlement took place on 28th December 2018. Thus, this is a forward transaction as the date of settlement is beyond second day from the deal. Thus, the rate used will be forward rate. Hope with this you are clear with the types of transactions. Most often in exams you will be given date of the deal and date of settlement, and you will be asked which rate to be used. Let us now understand what a direct or indirect quote is. In a direct quote, there is 1 unit of foreign currency and corresponding units of home currency. Since our home currency is rupees, So for us, direct quote will be 1 unit of foreign currency and corresponding unit of rupees. So let's see some examples of direct quotes in India, like $1 equals to 67 rupees, or £1 equals to 68 rupees, or €1 equals to 54 rupees are all examples of indirect quote. In an indirect quote, there is 1 unit of home currency and corresponding unit of foreign currency. As you can see, this is the reverse of direct quote. Let's see examples of indirect quote in India. ₹1 equals to $0.0250 is nothing but indirect quote because there is 1 unit of rupee and the corresponding units of foreign currency. Other example can be ₹1 equals to 0.0122 pounds or ₹1 equals to 0.0185 euros. In all these examples, you can see there is 1 unit of home currency, that is INR, and corresponding units of foreign currency. Another relation to remember is that direct quote equals 1 upon indirect quote. That is, you can find direct quote by calculating inverse of indirect quote or vice versa. Friends, in exam, a small question often comes from direct or indirect quotes. Let us solve a similar problem. The problem goes like this. Convert the following direct quotes in India into indirect quotes. We are given $1 equals to 67 rupees and £1 equals to rupees 90. So let's solve. We already learned the relationship between direct and indirect quote. That is, indirect quote equals 1 upon direct quote. Thus, indirect quote for $1 equals to 67 rupees will be 1 rupee equals to 1 upon $67 or $0.0149. And indirect for £1 equals to 90 rupees will be ₹1 equals to 1 upon 90 pounds or 0.0111 pounds. Let's solve another problem. The problem goes like this. Convert the following indirect quotes into direct quotes. It's given ₹1 equals to 0.0143 and ₹1 equals to 0.0109 pounds. So friends, please pause the video and solve it yourself. Hope you have solved this problem. So we already learned the relation between direct and indirect quote. So ₹1 equals to $0.0143 can be converted into direct quote as $1 equals to ₹1 upon 0.0143, which gives 69.93 rupees. Similarly, ₹1 equals to 0.0109 pounds can be converted into direct quote as £1 equals to ₹1 upon 0.0109, which gives rupees 91.74. Thus, these are easy to score questions in the exam. Friends, till now we saw the forex quotes like $1 equals to 67 rupees, which meant that bank is buying and selling at same rate, that is $1 equals to 67 rupees. But if bank do this at same rate, then how the bank will make profit? And what about the other technical cost which happen during exchange? So in practical, this is rarely the case, that is bank buying and selling at same rate. In fact, banks buy and sell at different rates. So the method adopted in actual forex markets is that of bid and ask or offer rate. Let's see what is a bid rate. Bid rate is the rate at which the bank will buy foreign currency. And ask or offer rate is the rate at which the bank will sell foreign currency. Also note that the difference between bid rate and ask rate is often called bid-ask spread, and it indicates the liquidity in the market. The difference in these rates represent the cost the bank incurred in these transactions, a small return on capital employed, and the compensation for risk it takes. So the banks use two-way quotation method to show the buying and selling exchange rate. As we learned, the foreign exchange quotation by the bank has two rates. One at which the quotation bank is willing buy and other at which it is willing to sell. The two-way quotation is generally written as $1 equals to rupees 67 hyphen 67.80. So the first rate denotes that bank will enter into purchase transaction at rupees 67, and the second rate shows that the bank will do sell transaction at rupees 67.80. Hence the principle buy low and sell high is followed in order to maintain the profitability and recover general transactional expenses. There are other forms also like $1 equals to 67.00/80. This also means the same. That is, bank will purchase at rupees 67 and sell at rupees 67.80. So don't get confused in examination. Another way to remember is that the selling rate is just higher than the buying rate, like just few decimal places. So in above example, please don't read as buying rate as 67 and sell rate as rupees 80. There can't be this huge difference in rates. This is a small trick you can use in examination. Now let's discuss an important topic, which is cross currency rates. Many questions come from this part, so please learn carefully. Friends, suppose you want to find the quote for INR Japanese yen, but this quote is not directly given by the bank. So is there a way to get INR Japanese yen quote? Yes, there is, and that way is cross currency rates. When dealing in a market where rates for a particular currency pair are not directly available, the price for the set currency is then obtained indirectly with the help of cross currency mechanism. The math is simple algebra which you learned in your 6th or 7th grade. That is, A upon B when multiplied by B upon C. Now B cancels out and you get A upon C. So in this example, where we need to get quote for INR Japanese yen, we can find this with the help of cross currency rate mechanism like this. Find INR US dollar and US dollar Japanese yen quote and simply multiply both. So US dollar cancels out and you finally get your desired quote, that is INR upon Japanese yen. This logic can be extended to any currency pair to get the exchange rates for which there is no outright market. Let us see another example. If euro per US dollar is 1.4 and GBP per US dollar is 1.6, then we have to find GBP per US dollar. So here you need to find GBP per US dollar quote from the given data. Well, the trick is see the third currency in the given data and make arrangements such that you finally get GBP per US dollar after cancelling out. So let's start from reverse. GBP per euro can be written as GBP per US dollar into US dollar upon euro. So here US dollar cancels out and you ultimately left with GBP upon euro. Now our task is to find GBP per US dollar and US dollar per euro, which we can easily obtain from the given data. As given the data, GBP per US dollar is 1.6 and US dollar per euro can be calculated as 1 upon euro US dollar, which is nothing but US dollar upon euro. Thus, US dollar upon euro is 1 upon 1.4. So now just multiply both these values to get the required currency quote of GBP per Japanese yen, which is 1.14. Let us see another concept of discount and premium. A currency is said to be at premium against another currency if it is more expensive in forward market than in the spot market. In this case, its forward rate will be higher than its spot rate. This happens when the future spot rate is expected to be higher than the current spot rate. And now a currency is said to be at discount if it is cheaper in the forward market than in the spot market. In this case, its forward rate will be lower than its spot rate. This happens when the future spot rate is expected to be lower than the current spot rate. Let us see an example. It is given that rupees per US dollar is 67.45/68 and 3-month forward rupees per dollar quote is 69.52/85. As you can see in this case, bank is ready to give only rupees 67.45 currently in exchange for a dollar, while it is ready to give 69.52 after 3 months. Thus, bank is charging only rupees 67.68 for selling a dollar now, while it is charging rupees 69.85 for a delivery after 3 months. So, the dollar is expected to be more expensive in the future. Hence, it is at the premium against the rupee. On the other hand, the rupee is expected to be cheaper in future and hence it is at discount against the dollar. Let's see another example. It is given that dollar per pound is 1.6721/26 and 2-month forward dollar per pound is 1.6726/34 and 3-month forward quote of dollar per pound is 1.6481/92. Here you can see exchange rate of pound is more for 2-month forward rate and less for 3-month forward rate. Thus we can say that the pound is at premium against the dollar for 2-month maturity but at a discount for 3-month maturity. Now we will see margins used by banks in foreign exchange. Friends, exchange margin is the extra amount or percentage charged by the bank over and above the rate quoted by the bank. When we are given the spot rate or forward rate with margin for buying rate and margin for selling rate, then effective rate will be calculated as, so you have to deduct margin from buying rate to get the desired exchange rate. Thus, buying rate will be bid rate minus exchange margin. Let's see an example. Given that dollar equals to rupees 68.480/0.900 and the margin is 0.08% and you have to find the bid rate after margin. So the new bid rate will be old bid rate minus exchange margin as we learned earlier. Thus 68.480 minus 0.08% of 68.480, which gives 68.480 minus 0.054. So new bid rate will be rupees 68.426. We saw bid rate, but what about ask or offer rate? So you have to add margin to selling rate to get the desired ask or offer rate. Thus, new selling rate will be ask rate plus exchange margin. Let's understand with the help of an example. Given dollar equals to rupees 68.480/0.900 and margin is 0.08%. So you have to find ask rate after margin. So as we learned, new ask rate will be old ask rate plus exchange margin. Hence 68.900 plus 0.08% of 68.900, which gives 68.900 plus 0.055. Thus new ask rate after exchange margin will be 68.955. With this we finish the theory and now let's solve some case studies. Pay attention to all these case studies as the pattern of CAIIB is shifting towards case studies. Let's start with the first case study. It goes like this. An Indian firm is interested in purchasing 5 million Chinese yuan. The following quotations have been given by two banks. Bank A, 1 pound equals to rupees 79.89/80.00. 1 pound equals to Chinese yuan 12.50-12.60. Now Bank B gives 1 Chinese yuan equals to $0.1598-0.1600 and $1 equals to rupees 40.00-40.05, and you have advised the Indian firm which quote they should accept. So you can see there is an Indian firm who wants to purchase 5 million Chinese yuan. So to purchase them, the firm goes to two banks, Bank A and Bank B, and those two banks give the quotations to the firm. Since the firm is Indian, it can give amount in rupees to bank and bank will give Chinese yuan to firm. So the transaction basically is firm needs to buy the Chinese yuan. So bank is actually selling the Chinese yuan. So bank will use offer rate, that is selling rate. Also note that no bank is exchanging rupees for Chinese yuan directly. Bank A is using pound as intermediary currency and Bank B is using dollar as intermediary currency. So you have to use cross currency mechanism to finally arrive at INR Chinese yuan exchange rate. So this is overview of the case study. Let's start solving now. Please note down the case study on a paper so that you don't need to come back to this slide again and again. As you can see in case study, our ultimate goal is to advise the firm from which bank it should buy the Chinese yuan. The funda is simple. Firm will buy Chinese yuan from that bank from where it has to give less rupees. That's a common business psychology. You will buy something from a seller which will cost you less. Thus, if you can find rupees per Chinese yuan somehow, then you can simply multiply 5 million with that rate and ultimately get the rupees that the firm has to pay. Let's see for Bank A. Bank A, it's given that 1 pound equals to rupees 79.89 hyphen 80.00. This is basically rupees per pound. Also given 1 pound equals to Chinese yuan 12.50 hyphen 12.60, which is our Chinese yuan per pound. Now, this can be converted as 1 Chinese yuan equals to 1 by 12.60 pound hyphen 1 by 12.50 pound, which is our pound per Chinese yuan. Notice that here bid rate is 1 upon 12.60 and ask rate is 1 upon 12.50 because we have to buy low and sell high. So our target is we have to find rupees per Chinese yuan, which can be found using cross currency mechanism as rupees upon pound multiplied by pound upon Chinese yuan. The pound will cancel out and we will finally be left with rupees per Chinese yuan. As you can see, the offer rate for rupees per pound is 80, which we can take from this equation. And offer rate for pound per Chinese yuan is 1 upon 12.50, which we took from this equation. Hope now you understood why we calculated pound per Chinese yuan from its above equation of Chinese yuan per pound. Now we can find our desired rupees per Chinese yuan by simply multiplying both these figures and we finally get 6.4. Thus, this is offer rate for rupees per Chinese yuan. That is, bank will sell 1 Chinese yuan at rupees 6.4. This implies for 5 million Chinese yuan, the customer has to pay 6.4 into 5 million. That is rupees 3.20 crores. Similarly, we have to find for Bank B. Let's do it quickly. Bank B, it's given that 1 Chinese yuan equals to 0.1598 hyphen 0.1600 dollars, which is our dollar per Chinese yuan. And $1 equals to rupees 40 hyphen 40.05, which is our rupees per Chinese yuan. And our target is to find rupees per Chinese yuan, which can be calculated as rupees upon dollar multiplied by dollar upon Chinese yuan. Now put the offer figure from equations above. That is rupees per dollar is 40.05, which we got from this equation, and dollar per Chinese yuan is 0.1600, which we got from this equation. Now multiplying both we get 6.408. This means bank will sell 1 Chinese yuan for rupees 6.408. This implies for 5 million Chinese yuan, the customer has to pay 6.408 multiplied by 5 million, which is rupees 3 crore 20 lakhs and 40,000. Let's see what the firm has to pay to buy 5 million Chinese yuan. So if firm buys from bank A, the firm needs to pay bank rupees 3 crore 20 lakhs to purchase 5 million Chinese yuan. On the other hand, if the firm buys from bank B, firm needs to pay the bank rupees 3 crore 20 lakhs and 40,000 to purchase 5 million Chinese yuan. So what are you recommending the firm? Bank A or bank B? If you answered bank A, then you are correct. Thus, we recommend the firm to purchase 5 million Chinese yuan from bank A, which is costing less to the firm. Let's solve another case study which goes like this. An exporter customer requests a bank to sell 25 lakh Singapore dollars. The interbank market rates are: in Mumbai, it's 1 US dollar equals to rupees 45.85 / 45.90. And in London, 1 pound equals to US dollar 1.7840 / 1.7850. Also, 1 pound equals to Singapore dollar 3.1575 / 3.1590. Now the bank wishes to retain an exchange margin of 0.125%. How many rupees the customer will receive? So friends, in this case study, a customer has 25 lakh Singapore dollars and he wants to sell those dollars and obtain rupees in exchange. The interbank market rates are also given, but as you can see, there is no rate converts Singapore dollar to rupees directly. So we have to convert Singapore dollars to dollar and then dollar to rupees. Can you tell what's the target in this case study? Our target is to find rupees per Singapore dollar, because if you can find exchange rate for 1 Singapore dollar, then you can easily calculate rupees the customer receives for 25 lakh Singapore dollar by simply multiplying the 25 lakhs with the exchange rate of rupees per Singapore dollar. So let's start. Again, please note down this case study on a piece of paper so that you don't need to come back to this slide again and again. Let's solve this case study in a step-by-step manner. Step 1 is the customer is selling, hence bank is buying Singapore dollar. So we will use bid rate, that is buy rate. So one thing is clear from this step, that we have to use bid rate out of the two rates. Step 2. In step 2, we will see what our target is. If we can just find the rate of 1 Singapore dollar in rupees, then we can calculate for 25 lakh Singapore dollar. Thus, our target is to find rupees per Singapore dollar. In step 3, let's arrange the data given in such a way that we finally arrive at rupees per SGD. Thus, let's use cross-currency mechanism to finally arrive at our target. Let's start from reverse. Rupees per SGD can be written as rupees per dollar into dollar per pound into pound per SGD. Thus, if I find these three exchange rates, then I can simply substitute these rates and find our required rate. Let me write all these equations again. So rupees per dollar can be found from this equation. Dollar per pound can be found from this equation, but pound per SGD can't be evaluated from this third equation. So we need to find the inverse. So the inverse of this equation is this. So from here we can put the value of pound per SGD. So we finally got all the values, and let's substitute these values into this cross currency equation. Since we have to use bid rate, so we get 45.85 into 1.7840 into 1 upon 3.1590. So we finally get 25.89313. Thus we get our desired exchange rate of rupees per Singapore dollar as 25.89313. But there's one thing more in the equation. that is exchange margin. Since we are using bid rate, so you have to less the margin. So let's less the margin as 25.89313 minus 0.125% of 25.89313, which gives 25.8607. Thus, bank will buy 1 Singapore dollar for rupees 25.8607, which implies 25 lakh Singapore dollar into 25.8607, which gives rupees 6 crore 46 lakh 52,000. Thus, the customer will get 6 crore 46 lakh 52,000 rupees. Hope you are clear with this case study. If you face any doubts, please ask your doubts in the comment section. Let's do another case study. It goes like this. Calculate how many British pounds a London-based firm will receive or pay for its 4 foreign currency transactions. The first is the firm receives dividend amounting to rupees euro 1,20,000 from its French associate company. The second is the firm pays interest amounting to rupees 2 lakh euros for its borrowing from Japanese bank. The firm exported goods to USA and has just received US dollar 3 lakhs. And the fourth is the firm has imported goods from Singapore amounting Singapore dollar 4 lakhs. And we are given these exchange rates. And please note that the firm is London based, hence pound will be the home currency for this firm. So let's start solving each part one by one. Also, please note down the question on a piece of paper so that you don't need to scroll back to the screen again and again. Let's solve the first part. The first part stated that the firm received dividend amounting to rupees 1,20,000 from its French associate company. So friend, the firm received the dividend from its French associate company in form of euros. So the firm needs to convert those euros into its home currency, that is pound. Hence the firm will be selling euros and bank will be buying those euros at 0.60 rate. Hope now you can figure out from where we are getting these figures. We got this figure from here, that is 1 euro equals to 0.60 slash 0.61 pound. Thus the bank will buy 1 euro at 0.60 pound. So bank will buy 1,20,000 euros at 1,20,000 into 0.60. Thus the firm will get 72,000 pounds for this transaction. The second part of this case study asks, the firm pays interest amounting to 2 lakh yen from its borrowings from a Japanese bank. In this part, you can see that the firm has to pay interest, and that too in form of yen. And the firm is London based with home currency pounds. Thus the firm needs to buy yen in order to pay the interest. So we can say that the firm will be buying yens and the bank will be selling yens. And the exchange rate given is 1 yen equals to 0.0049 slash 0050 pounds. Thus 2 lakh into 0.0050 equals to 1000 pounds. Hence, in this transaction, the firm needs to pay the bank 1000 pounds in order to get 2 lakh yens. The third part states, the firm exported goods to USA and just received US dollar 3 lakhs. Here the firm will be selling dollars and the bank will be buying dollars. The exchange rate is given as $1 equals to 0.50 slash 0.51 pounds. And we will use bid rate of 0.50 here. So the bank will buy $1 equals to 0.50. Hence the bank will buy $3 lakh for 3 lakh into 0.50 equals to 1,50,000 pounds. The fourth part asks, the firm has imported goods from Singapore amounting to Singapore dollar 4 lakhs. Here the firm shall be buying Singapore dollar in order to pay the bill of Singapore dollar 4 lakhs and bank will be selling Singapore dollars. Also, the exchange rate given is 1 Singapore dollar equals to 0.39/0.40 pounds. So we will use the offer rate here, that is 0.40. Thus 4 lakh into 0.40 gives 1,60,000 pounds. Friends, with this I wind up this lecture. See you in next lecture. Don't forget to subscribe this channel by hitting the red subscribe button below this video so that you receive the notification of each lecture and each study material on time. Also, please check out the description section of this video to see latest CAIIB related study materials which I have updated from time to time. Also, do like this video and also post your queries in comment section. Do write how you like this lecture so that the improvements in further lectures can be made. Thank you. Happy learning.